The UAE Corporate Tax Decree Law operates on a clear baseline. It taxes commercial business and profit across the jurisdiction. By default, it eliminates almost every profitable enterprise. Yet certain entities remain protected. Article 4 of the Decree Law lists 9 specific categories of persons exempt from corporate tax. These statutory carve-outs protect specific state functions and primary economic drivers like the natural resource sector. We can organize these 9 statutory categories into an entity classification matrix built on 4 policy pillars: sovereign operations, emirate-level double taxation, public welfare, and fiscal transparency. Securing a place within these pillars requires meeting rigorous statutory conditions. The law actively monitors these criteria. To protect the tax base, the framework utilizes a concept called ring fencing. If an exempt entity conducts commercial activities outside its protected mandate, the law mathematically isolates that specific leakage and subjects it to taxation. Mastering UAE corporate tax exemptions depends on the operational mechanics of boundary containment rather than entity classification alone. The first pillar covers sovereign operations. The law structurally exempts the federal government, local governments, and wholly owned government-controlled entities. These institutions perform mandated activities and exercise sovereign powers purely in the public interest. Because they operate without a commercial profit motive, taxing them would simply move state money from one pocket to another. If a government entity conducts business under a commercial license unrelated to its mandate, it triggers tax liability for that activity. This requires mandatory compliance deconstruction. The entity must treat the commercial branch as an independent business, maintaining entirely separate financial statements. Because the commercial arm and the mandated entity share the same organization, internal transactions between them are legally reclassified as related party transactions. These internal dealings must strictly comply with the arm's length principle, ensuring the exempt side does not artificially absorb the profits of the taxable side to erode the tax base. To ease the administrative burden, the law allows a local or federal government with multiple taxable businesses within the same emirate to apply for tax consolidation, permitting them to file a single return. Sovereign immunity fiercely protects public functions. It provides absolutely zero tax shelter for state-owned entities competing in open commercial markets. The second pillar addresses the UAE's natural resources, which are constitutionally owned by the individual emirates where they are located. Private concession holders extracting and exploiting these resources already pay heavy royalties and taxes directly to their respective emirate. Articles 7 and 8 exempt these specific businesses from federal corporate tax to prevent taxing the exact same activity twice. This exemption applies to a strict supply chain boundary. The protection is exclusive to the concession holder, explicitly excluding contractors, subcontractors, and suppliers operating around them. This animated chart tracks an extractive entity's revenue to illustrate the 5% ancillary rule. If ancillary revenue exceeds 5%, it is severed and treated as a taxable business. Any shared expenditures must then be strictly prorated based on these revenue ratios. The federal corporate tax regime completely respects emirate-level resource taxation, while utilizing exact mathematical formulas to trap and tax any non-extractive overflow. The third pillar contains qualifying public benefit entities, governed by Article 9. Merely operating for a charitable, religious, scientific, or cultural purpose does not grant tax exemption in the UAE. To secure this status, the organization must clear a mandatory statutory hurdle, applying directly to the Ministry of Finance. It must be explicitly evaluated by the federal government and listed by name in Cabinet Decision No. 37 of 2023. Once listed, the entity faces a negative structural constraint. Absolutely no part of its income can be payable for personal benefit. The wealth must remain trapped within the public benefit purpose. As a secondary benefit to the wider ecosystem, taxable persons who make donations to these specifically listed entities can legally deduct those contributions from their own taxable income. Philanthropic intent carries no legal weight for corporate tax purposes without formal governmental registration and strict financial sequestration. The final pillar covers qualifying investment funds and family trusts. designed to protect the UAE's status as a global wealth management hub. Fiscal transparency lets capital flow unobstructed through the fund directly to investors, bypassing entity-level tax. To earn this, Article 10 requires strict regulatory oversight, and ownership must be widely dispersed to prevent concentrated tax avoidance. Real estate investment trusts face specific constraints: assets exceeding 100 million dirhams, 20% publicly floated capital, and 70% real estate income. Article 17 addresses family foundations and trusts. By default, family foundations incorporated in the UAE have a separate legal personality and are subject to corporate tax. To bypass this, these trusts must proactively apply to the federal tax authority. If they only manage savings and investments and conduct no commercial business, they can be legally treated as an unincorporated partnership, gaining fiscal transparency. Fiscal transparency is a granted legal fiction. It requires high regulatory burdens and dispersed control, ensuring it's used for collective investment, not weaponized for evasion. UAE corporate tax exemption is not a permanent right attached to a corporate structure. It is an ongoing, fragile state of compliance. Failing to meet statutory conditions at any time during a tax period shatters the exemption. The loss doesn't start on the failure date. Instead, a retroactive penalty strips the exempt status from the beginning of that entire tax period. The Minister of Finance provides a narrow exception. An entity may maintain its status if it can prove the failure was purely temporary, was promptly rectified, and that strict compliance monitoring procedures have been implemented. Compliance under Article 4 depends on continuous boundary monitoring, precise cost apportionment, and aggressive operational ring-fencing.